In this episode, we speak with Bill Martiner, the co-founder and CTO of Avenue One, a technology service platform and investment marketplace for institutional owners, buyers, and sellers of residential rental real estate. With deep experience in driving growth and innovation for the financial services industry, Bill co-created Avenue One in 2020. The company's platform connects local experts to institutional capital, making investing in housing, debt, and equity more efficient for institutions while also supporting local businesses. With a highly impressive technical background, Bill was previously head of enterprise technology at Compass, CTO at York Capital Management, a founding partner at VenturePM, and the head of IT and operations strategy for Nomura Securities. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow. Bill, thank you for taking the time to chat with us today. It's a delight to be with you.
My pleasure. Thanks for having me.
This is going to be very interesting to our broader audience because you actively work in an asset class that we all know quite well. So let's go into exactly what Avenue One does in, I guess, the investing landscape.
Sure. So let me start off with some headlines for what we are and what we do, and then we can dig down a bit into the specifics. So basically, we're a platform that is focused on single-family home rentals.
Mm-hmm.
What we do is we act as a platform that bridges the large institutional capital with very local owners of these assets and real estate service providers. We provide that connective tissue that allows those two sides to transact. We're asset light, we have no balance sheet, and we're a networked business model. So most of our field operations is done through partnerships. And I think that's very key to our ability to scale and really some of the core tenets of the business.
Excellent.
So let me speak a little bit about the market context. Like you said, anybody who lives in a home is kind of familiar with this asset class, but may not be that familiar with the single family home rental business. So it's larger than I thought before I was introduced to it. So we're talking about 15 million homes in the US with an asset valuation of about $4.7 trillion. Now, it's kind of a sneaky asset class in that it's not really held by any large investors to a large extent. About 96% of this is owned by smaller investors. Think successful dentists, or like a guy who opened a gas station, opened another one, and then started buying homes, renovating them, and then renting them out as an additional revenue stream. Most of these things are held by investors who hold less than 10 of these assets. And because it's held by these small investors, it's not terribly efficient. These are not professional investors as such. These are not professional landlords very typically. And a lot of times they'll do a job for their tenants, which is not as good as it could be. So a $4.7 trillion addressable market is a big one. Now, there are institutional players inside this space, and you'll recognize some of the names. American Homes for Rent, Pretium. There's some very large players in this space. They're getting a lot of headlines. But again, they're only really controlling about 3% of this market. So it's very nascent from an institutional standpoint. Mm-hmm. And if you ask yourself why, it's honestly because it's an asset class. It's kind of a pain in the ass. So if you have the ability to invest in a multifamily unit or really any other asset class, your life is a lot more simple. So if you can just make loans with that same money, then all you have to worry about is collecting the payments. If you invest in a multifamily property, you could have 200 units at the same address, mm-hmm. which means that you could put one super in that building and you could service all of those units pretty efficiently. Now, enter single-family home rental. These are all individual assets. This is scatter lot real estate investing. It's all over the place. Every home is weird in its own way. These are built at different times. They have different mechanicals. They have different problems. And it's highly, highly, highly local. Mm-hmm. The kind of problems that you'll run into in the Phoenix market is distinctly different than the type of problems that you can run into in Orlando, Florida. Mm-hmm. So that's kept institutional investors at bay from this asset class for some time. So obviously that's an opportunity. This is an interesting asset class from an investor standpoint. It's not correlated. It has generally good returns. And, it's something that a lot of larger investors want to get into. But there's such barriers to getting into actually managing them. Those large institutional investors have had really only two choices to get SFR exposure. They can go to one of these funds and pay the heavy promote that's involved with that exposure, or they can build out their own operations. They have to build their own acquisitions machinery. They have to build their own transactioning machinery. They have to build their own inspection and renovation machinery. And then they need to manage these things on an ongoing basis. So that's also rather expensive. So either way, they either have little control and a high promotes, or they have a lot of overhead and a very long time frame to get that exposure. That's where we come in. We're a turnkey solution for these type of investors that will allow them to get SFR exposure in as turnkey a manner as possible. But that's not enough. They'll also need to see scaled investment. So we can provide not only turnkey, but scaled investment in SFR. And again, we do this by not holding balance sheet with this networked model, which allows us to build into this scale and have these efficiencies. That's basically where we are, what our market context is, and what the business is all about.
Entering into the business of networks and marketplaces is extremely challenging. Do you build one side first to get to a critical mass, then to attract the other side? Do you build up both sides simultaneously and actively promote the marketing of each side? The thing that sounds complicated here is gathering these individual properties and getting into communication with the owners to participate in your market. How do you go about doing that?
Well, that's something that's structurally advantageous about this market. So if you own a home, like I do, you know that when you need something done with real estate, there is already an existing network that's on the ground. So your real estate broker knows inspection professionals. Your inspection professionals know construction professionals. Your construction professionals know property management professionals, and everybody kind of knows everybody on a local basis. The problem is it's fragmented, and the problem is that it's organic and not designed. And the connectivity that exists between these participants in that market is really word of mouth. It's just straight relationships. So structurally, what's been an advantage for us is that once we get a foothold into the local network, we get passed around by word of mouth. And so we can bring these folks into our business model because they're doing it already. And we're just in a more efficient way of doing it. And we're showing up with institutional capital, which makes it much more engaging to get involved with this. So that's been an approach. Now, to do that, we need to stay very, very, very focused on the service providers and the local owners of assets winning through their engagement with us, that our interactions are as frictionless as possible. It's a good value proposition for everybody that's involved. And that's why it's so important to understand the business model as a two-sided network. On one side, we've got these institutional investors. On the other side, you have these asset owners, and you've got these service providers. And all of them are customers. We're just the place in the middle that brings them together and allows them to transact.
Mm-hmm. Now, are the institutions on the one side of the platform, are they seeking to own all of the real estate? If for the owners in the local communities of these homes, they're getting, rental income. So are these folks looking to exit completely from the property?
Some are, some aren't. So it depends on where the local landlord is or, where the seller of the home is. Mm-hmm. So if a seller's moving, sometimes we'll buy off the MLS and we'll make it a rental property. But that's less and less. Most of our business is coming from local landlords, either want out of the business or they want to divest some portion of their portfolio. If you're a landlord like that, let's say you have 10 units, you may not have a lot of liquidity and you still got to live your life. So what are you going to do?
Mm-hmm. And is the other efficiency you introduce on the services end? You talked about maybe property management. So I guess there's economies of scale being able to work in a community where your homes could be a mile apart, but you have like 10, 15, 20 homes. Your property management company can do that with like two people.
So, like, we're not a property management company.
Hmm.
We work with property management partners. So, your point is well taken that in any given area, two people could service these homes. But if you've got 500 units in that area,
Mhm.
you need more than one property manager. And the other thing that's interesting about the property managers, it's interesting about all these local market participants, is that they have a lot of local knowledge. So we're buying these homes, we're underwriting these homes, we're using a lot of data, we're doing a lot of analytics, a lot of machine learning to figure out which ones we should buy. And that tells us everything that we can learn from the data that's available. But we don't know what people are gossiping about, where a new road is going, or
Mhm.
somebody who's developing something. So it's hard to overstate how important the local expertise is in allowing us to be what we are.
Now, the demand side here, the end user, the person or family that would rent the home, increasingly they're seeing opportunities to do so in a new home, say like Toll Brothers building, entering the market, or one of these big home builders constructing brand new properties.
We're into that as well. So BTR is a focus for ours as well. From our standpoint, we want to transact with those houses. We want to be able to manage these houses. We want to get institutional capital access to this exposure. And we want our local service providers to do well as a part of this transaction. So it's all good. Doesn't matter where it comes from. House is a house.
So I live in the Princeton area and I know these folks that actually own 10 homes. And that the example that you shared with us, I'm very familiar with that. And so what would the return profile look like, say if I were one of those people and I had the 10 homes and I had a yield off of those assets?
Well,
Alternatively, if I came in on the other side as an investor in your platform, how would the yields compare?
well, let me first say that in Jersey, it would not be good because your
Hmm.
tax rate's too damn high. By the way, I'm just across the river from you in Bucks County.
Oh,
Um,
okay. We
so
should get together.
yeah, that'd be nice. So if you are managing your own properties, we've actually done studies around this. So we're in a unique place from a data standpoint in that because we bought existing portfolios and then we've managed those portfolios, we get a very rare glimpse at kind of a before and after picture. So if the portfolio exists, it's existed for years, it's making a certain amount of rent and it's costing a certain amount to operate, we have that data. Then after we operate that for a period of time, we're able to take a look at those same properties in that same location under different management, and we're able to compare the two. Nobody who doesn't do business with these acquisition of portfolios can really have any insight into what that looks like.
Hmm.
What we've found and what we can show statistically is that there is a 15% management premium in our favor for those that are professionally managed versus those that are managed by a smaller landlord.
Hmm.
There are economies of scales that kick in. There is better knowledge of the market, better ability to set rents, a better understanding about what renovation scopes will maximize a rent. And all of that comes out to be a really powerful effect. Now, it's 15% for just the management portion. If this is a property that has an existing tenant in it, that tenant turns, and we have the opportunity to rehab that, then the margin goes up by about 20%.
Hmm.
So there's real demonstrable, statistically valid premiums that are associated with professional management.
Fantastic. No, I think you explained this very well. Interestingly, our podcast is about the entrepreneurial journey, but since you know so much about the technical aspects and financial aspects, I thought I would delve into those areas.
Absolutely.
Tell us a little bit about your background. You've been in technology, you've been at this intersection of finance and technology. Share with us a little bit about your
Yeah,
background.
I've been in finance for longer than I want to admit. on both sell side. So I worked at Nomura Securities for a long time. And then on buy side, where I worked at York Capital for a long time. After my stint at York Capital, I went to work for Compass Real Estate and headed that up. And that was where I started to build some real estate shops. So that's kind of my background. When I view the real estate market, I necessarily view it through a vantage points that's necessarily very financial services colored. So I really look at these things. I look at SFR as the most fixed income type of equity. And there's a lot of good parallels between this market and the mortgage market that has come to be over the last, how many decades. It was not that long ago that mortgages were whole loans sitting on community banks' balance sheets. But with some innovation and maturity in the markets, this is now the largest, most liquid asset class in the world. So with that view, it's hard for me not to see the evolution of the SFR industry in parallels to that. It'll just take some time for it to mature and for innovation to happen inside this space. And it's certainly a big enough market to see some really interesting developments.
You touched on the property taxes here in New Jersey and why that is prohibitive to maybe implementing a good SFR solution vis-a-vis your platform. I'm sure you've already done this, but across the US, you already know which areas you want to be in.
That's right. And at the end of the day, it's all about price performance, right? So the high tax rate jurisdictions weakens the price performance. Just does. So if you can invest elsewhere, why wouldn't you?
Right.
So yeah, Sunbelt is very attractive for us. From a tax standpoint, it's also very attractive for us because the maintenance is lesser and you can run renovations year round. Unlike here, where I'm sure you still have snow on the ground as well.
We do. So related to volume, how has the platform done? Has it met your expectations for the number of dollars flowing through?
This thesis has worked really well. In the last week, so we're 4 years old now, and we did a lot of this very deep thinking about the network model, how we were going to operate during the last really snowy winter we had, which was a number of years ago. And so now it's time to take a look at these things again. And it's interesting to take a look at these and see that the type of predictions that we did in the past really have played out with some fair accuracy. I don't want to be boastful, but I think we're batting 65, 70% in terms of the assumptions actually playing out, which is surprising to me. But this is a platform that's deployed over $2.2 billion. Our average revenues during the time that we've been alive have been above $50 million a year. We've seen peak revenues of $80 million a year and a peak EBITDA above 40%. So it works.
That's fantastic. And so kind of the way the platform makes money is through the participants.
It's through fees.
Yeah.
So there's a fee model that's associated with all the different work that we do that is set up in such a way that it aligns us well with the investors who trust us with their money. So there's paying points for actual economic benefit.
And then when you take a look at, maybe areas of the business that are the most challenging and maybe presenting some constraints, the technology aspect of it maybe doesn't seem as cumbersome as the property kind of outreach and getting to know localities.
It's all kind of cumbersome.
Yeah.
So
if
you compare this model to an Airbnb or an Uber, same kind of deal, right? So Uber and Airbnb, they don't own cars, they don't own hotels. They just coordinate buyers and sellers. Very complex because you've got all these local jurisdictions and you've got to build this connective tissue in between there. And you need to make good decisions about who you are hooking up with whom. And so it's complicated from that standpoint. It's also complicated on the ground. And the biggest complication has to do with ensuring that work is being done at a certain level of quality, consistent quality. So we do have boots on the ground in all these different jurisdictions, but the technology and our processes that have grown up really are around delivering good quality product at a competitive and dependable price point.
Mhm.
A lot of the work has to be done around that. So there's a lot of variation under the hood there. But at the end of the day, if the quality is good, if it comes under a certain price point, if it has a certain yield, then we've done the fundamental good stuff for our stakeholders.
Mhm. Does anyone get displaced from what you're doing? It seems like you're a big enabler. Avenue One is enabling all the participants to do what they do better.
I think that's what turned us on right at the beginning of the business. So we looked at this huge opportunity. The approach was logical and the approach felt good because everybody wins.
Mhm.
Investors get access to this asset class. Local service providers, whether local landlords or local home sellers, get access to liquidity if they need it. Local service providers get business, and we have pumped tens of millions of dollars into places like Charlotte, North Carolina. It had real impacts on that service economy. And at the end of the day, the investors get an attractive yield that's not correlated and that they can actually get up to the scale that makes it interesting to them. So like everybody wins.
We're coming up on the tail end here. I do have two final questions I like to end with. One is, can you tell us about a person who has had a profound influence on you?
Okay. I'm a big fan of the older, kind of less sexy business thinkers. So I have always been a huge fan of W. Edwards Deming,
Mhm.
who, if that sounds like a name of some guy from the 1950s, it's
Mhm.
because it was. And just his thinking has had a lot of influence on me. His idea of the appreciating a system. So like really understanding suppliers, producers, customers, your goods and services, understanding how the beast works. I think without understanding the context and the structure of this market, we may well have taken a different business model and one that's much more common, less scalable, and less successful in the end. The other thing that I really like about him is this whole idea of what's called the Deming cycle of plan, do, check, act. Because I think if there's one thing that you need to do as an entrepreneur, so you need to be willing to fail and then willing to learn from that failure. So by approaching a lot of things from that standpoint, okay, you do your homework, you plan as well as you can, then you got to do what you got to do. You got to have some execution discipline. But then after you do, have the discipline to check that you did the right thing, have the humility to understand that not everything's going to work out, and then act to correct that, and then keep on going through that cycle. That's a thinker that I encountered pretty early in my career and has really guided a lot of my thinking. What's funny is like a lot of those same things, a lot of things that Deming says, is all the stuff that gets branded and revamped in the popular press. So like customer focus, fanatical customer focus, that's just an echo of Deming. This stuff is nothing new under the sun.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
So as a technologist that lives in the woods, I've got a couple of different focuses. I have been involved with the Electronic Frontier Foundation forever. They're like an ACLU for the digital world. I've been a supporter for them for a long, long time. Their privacy concerns, all the rest of that stuff, I think is such a necessary offset to the pace of technological innovation in the world today that I think they're very, very important. I'm also a big supporter of the Nature Conservancy, and their efforts to protect and preserve wild spaces. I think that's a huge need in today's world. Lastly, so I'm a person with ALS, and because of that, that's what Stephen Hawking had. Because of that, I've become much more involved in the research and support efforts around the community that are dealing with that disease.
Well, Bill, this has truly been a wonderful conversation. Thank you again for taking the time. I know our audience will find this very helpful. Thank you.
My pleasure. Take care.